Cynthia, do we have a quorum?
Yes, we have a quorum.
Great. Then I would like to call the March 8th, 2019 Board of Administration meeting to order and begin with non-agenda public comment. And I have a speaker slip from Joe Flynn. Joe, you have 15 minutes.
You're too good to me. Anyway, President Hoy, members of the board, my name is Joe Flynn, retiree. I wanted to thank all of the board members for your volunteer service to the City of San Diego Employees Retirement System. We can never thank you enough, but we keep trying. Your service is much appreciated. Today, for the 3 trustees who are leaving the board, I would like to thank each of you for your 8 years of service. Bill Hayner has volunteered his considerable experience and expertise to the board for 8 years, and his thoughtful remarks always added an important dimension to the deliberations. Val Hoy, you had brought your legal and financial skills to the board, and as president has guided the board to excellence. I had the honor of serving with Tom Sullivan's brother, Mark, and the Sullivans and the retirees are justly proud of their 16 years on the board. San Diego has always been very fortunate in having volunteers who donate time, effort, and expertise that the city and SDCERS could never afford. Your service is the embodiment of the motto over the west entrance of the Civic Center on Harbor Drive. That is, that the noblest motive is the public good. Thank you for your service and best wishes.
Thank you, Joe. Next, I'd like to call on Greg Rademacher.
Thank you. You know, we appreciate our board members' service every day, but it's also fun to celebrate milestones. And as Mr. Flynn pointed out, we do have some milestones to celebrate today. But we also want to thank, in addition to those 3, we have additional 2 board members that are achieving some milestones and completing a term of service, but also we're hoping they'll be continuing with us. And the first is Karina Coleman. So she was appointed to the board in January of 2016, has served 3 years on our investment committee. Thank you very much. And she's completing her first term, and we're really pleased that she's seeking reappointment for another term. And some of you may not know that Karina joined us actually as an independent board member on the investment committee before starting her board service. So we'd like to recognize and thank Karina. Our second board member we'd like to recognize is Charlie Hogquist. He was elected by the retirees in September 2016, has served 2 years on the Business and Governance Committee and also on the Disability Committee service, serving as chair for our Disability Committee in 2018 and is currently the committee chair. And he's completing his first term as retiree elected as of March 31st, 2019, and was recently reelected to another term. So we're welcome Charlie back for another 4-year term. Some of you may not know, but Charlie was also previously a board member on SDCERS as the elected police safety member back in 2003 through 2005. Let's congratulate and thank Charlie Hogquist. But we should recognize and thank 3 board members whose service is coming to a close. And I mean this very respectfully, but who are these old timers? They were responsible for building upon our good governance foundation with further improvements to charters, policies, and rules. During their board service, the board has created an investment committee charter, created a securities litigation policy, creating an insider personal trading policy and member benefit appeals policy, creating rules on our adjudication processes and contributions and service credit rules. They were also responsible for organizational improvements. For example, we successfully implemented a pension administration system, implementing PEPRA plan tiers, for the port and airport plan sponsors, implementing city police benefit tiers, closing the city general benefit tier due to Proposition B, resolving outstanding litigation, just highlighting substantially equal contributions, the Krolikowski case, which had a very favorable published appeal in the Court of Appeal, PSC Case Part 1 addressing service credit calculations, PSC Cases Part 2, we resolved 3 of the 6 actions, with the remaining 6 actions in the Court of Appeals. But I think when people think back about these 3 old-timers, I think they'll remember what they've done for the funding of the plan, most of all. I was looking at that, and during their time over the past 8 years, the portfolio's increased $3 billion. And I go, that's a big number, but you know, how do I get my head around that number? And through the miracle of mathematics, figured that out. That is actually about adding $1 million per day over 8 years. So that is quite significant. And that's done through a variety of things. It's the leadership over the investments and minimizing investment costs through passive investing, reducing fees through consolidating active management relationships, expanding global equity allocations, de-risking the real estate portfolio ownership structure, adding infrastructure to the portfolio, creating an opportunity fund to capture attractive opportunities, moving fixed income to a higher core quality and lower duration. And again, it's just amazing, $1 million per day during your tenure, even after taking into consideration our mature plan's negative cash flow. Along with that, funding the plan includes crafting a rigorous actuarial funding strategy. We created an actuarial funding methodologies and assumption rule, created a funding objectives policy. We implemented level dollar amortization periods for the closed plans, strengthening our mortality assumption, and lowered the investment earnings assumption from 7.75 to 6.5% to better meet our long-term expectations, and has recently established a minimum UAL contribution floor. So again, I ask, who are these old timers? I know you all know them. The first to be recognized is Tom Sullivan, elected by the police members in April 2011, served 2 complete terms, and I must add that is much longer than your brother. 8 years on the Business and Governance Committee service, and also has stepped up to serve as that committee chair on more than one occasion. Let's congratulate Tom Sullivan. Our second is Bill Hayner, appointed in April 2012, served 2 complete terms, 8 years on the Investment Committee, also serving as the Investment Committee Chair in 2016. Thank you and congratulate Bill Hayner. And last but certainly not least, Valentine Hoy, appointed in April 2012, served 2 complete terms, 2 years on the Disability Committee, 8 years Business Governance Committee, with serving 4 years as committee chair, and most recently serving 2 years as our distinguished leader as our board president. Let's recognize and congratulate Mr. Hoy. And I would be honored if I could take a picture with you, presenting you with a very nice plaque signed by all of your fellow board members, expressing their appreciation for your advice, collegiality, commitment, and service to the Board of Administration staff, SDCERS members, retirees, and beneficiaries, for your very important part in delivering our mission to deliver accurate and timely benefits and ensuring the trust fund's safety, integrity, and growth. So a quick photo op?
Sure. Awesome.
Yep. Oh, I get all 3 of you.
Come on, let's go, guys.
We're not doing 3 pictures, people. We're doing 1. Let's go. That's right. We're efficiency.
Eyes are red. Except you.
Thank you so much.
Oh, mine's not red. I'm trying to make it a sunny day.
It's a little red umbrella. That is a very cute.
Well, figure if I'm gonna be on television.
All right, we've had enough non-agenda public comment for the day. Let's get to business. I do want to say that the accomplishments that Greg just went through, while I appreciate the fact that this board has served admirably and stewarded this organization, the accomplishments are really more the result of our staff and our consultants, who are outstanding. And I don't think any of us could say enough good things about the staff of this organization. And also, our consultants, two of our key consultants are here today, and I'm glad to be leaving with them in the room because they do an outstanding job for us. So what I'd like to do is ask the board to recognize our staff, as well as Chiron and Steve and his team for everything they've done for us. And with that, I will move the approval of consent agenda items A through D in the agenda. No second. We have a second from Charlie.
Ready to vote?
We have a 12-0 vote.
Oh, we were just waiting for Bill.
Bill, did you vote?
You're not off the board yet, Bill.
We've been having some
Slacker.
technical difficulties. so-
It shows who voted.
Okay, he's got to hang in with us for
All
a
right.
couple more hours.
Just want to
Come
move,
on.
go ahead.
Yeah, I'm going to move on. So that passed unanimously. Next item we have is to take investment committee action items out of order so that our consultants can speak. So I'll turn the floor over to Carol.
Great, thank you. Today, we're going to have two presentations by Aon Hewitt. Steve is going to cover the annual asset allocation recommendation, and Katie is going to cover the portfolio structure and implementation. These are two analyses that we do annually that are really important and kind of the cornerstone of our investment program. And it's an important board level responsibility to review and approve these matters. So we're going to go through the two presentations and then we'll vote afterward. Thanks.
Good morning, and thank you for having us here. Steve Voss from Aon with Katie Comstock. If we could go ahead and pull up our presentation.
Which one are we doing first, the asset allocation?
Yes, there should be one presentation that includes both. And I see it on my screen in front of me. It's titled Asset Allocation and Portfolio Structure Review. So as that's coming up, you hear us once a year come in front of you and talk about the asset allocation. We routinely say that it is the single most important decision that this board makes. We don't take that decision lightly. We want to make sure you are prepared. We spend a lot of time working with the investment committee, working with investment staff, and setting a long-term policy that we think kind of bridges that tension between eating well and sleeping well. We know why we're here. We have to pay benefits at the end of the day. We're very conscious of what those benefit payments are. We're very conscious of what your liquidity requirements are. We want to make the most efficient use that we possibly can of your risk and return and your fees, the fee dollars that you have to pay to help defease those benefit payments over time. Constant change is not rewarded, but going back and scrutinizing and revisiting past decisions is always a best practice and something very important that we want to make sure we all spend time doing. So again, with working on behalf and very closely with your investment team and very closely with your investment committee, we do that on an annual basis. So let's take a look at a couple things that we're going to be doing today. I'm going to talk about our capital market assumptions. These are the ingredients that go into an asset liability study that we completed in January, and they're also the key ingredients that we use to figure out how best to structure your investment program for good times and for bad times. I'll also talk about that review in general and give you one recommendation or suggestion that we talked about yesterday with the investment committee. And then Katie will talk about the structure. So once we figure out how we want to invest that 78% return seeking and the 22% risk reducing assets, we then need to take into consideration what types of managers, what types of fees will we be paying, what type of liquidity structure will we have with those investment managers. And that's what we'll be focusing on towards the tail part of our discussion. today. We plan to spend about 20 minutes. I'm going to skip a few of these slides, but if there's anything that comes to mind or anything that you want to talk about, please do pause us and ask us to hit those items. So in January, we reaffirmed that 78-22 mix. Today, we're going to be talking about asset allocation. The things that we're interested in most is how to build that 78-22 efficiently, protecting on downside risk. That was something we spent a fair amount of time talking with the investment committee and the full board last January, is how can we mitigate downside risk? We've been through what is quite possibly the longest and greatest bull markets of all time that ended in December of last year, sadly. But how can we protect against equity drawdowns? I'm going to show you a slide in a few minutes that illustrates that equities represent 41% of your total investments in nominal dollars, but roughly 90% of your risk. That has served us remarkably well over the last 10 years, during the tenure of many of you and then those trustees that will be leaving soon. We've seen tremendous market growth, $3 billion over the last 8 years alone. Truly, truly terrific. We don't think that's going to continue. You've heard us saying that at the investment committee level, and you've heard us say that at the board level. So we want to try to protect against that downside volatility. We have a suggestion that we brought to the investment committee yesterday that includes the investment of managed futures, and we'll spend a few minutes on that here in just a little bit. So very briefly, cap market assumptions, what are these? These are the components that go into the study. This is return expectations. This is volatility or standard deviation of those returns, and then the correlations across asset classes. How do asset classes behave together in various economic times? Return is the most important. That is the biggest long-term driver of your investment program's success or a lack thereof. So we spend a fair amount of time making sure that we get the returns right. We revisit these on a quarterly basis, and we report them to you on an annual basis at meetings just like this. The returns are built on what we call a building block approach. This is an example of how we come up with the equity market expected rate of return. We take forecasts and look out 10 and 30 years and do our economic modeling for you over 10 and 30-year periods. For domestic equity, the components include income, growth, inflation, and in aggregate, those equal the roughly 6.7% return that we believe the equity market will generate over the next 30-year time period. So when we bring all these return expectations together and the risks together and compare that and calculate that relative to what it is your current long-term board-approved policy is, you can see the results at the bottom of the slide. Our expected return is 6.91%. You may recall that return from the last time we were together in January. Here it is again. You can see the return at the top for domestic equities, 6.7%, with a pretty significant volatility of 18.4. We'll take a closer look at volatility in just a few minutes and how that translates into expectations over long periods of time. It's often instructive to look in the rearview mirror and see what has happened in the past. So what we have done here is shown what it is that your actuarial assumed rate of return has been going back to 1994. You, like many public pension funds over the long term, have used numbers as high as 8% for the actuarial assumed rate of return. More recently, you've been gradually bringing that down per the advice of your investment consultant, us, and per the advice of Chiron, your actuary. And you're currently at 6.5% in terms of your long-term expected rate of return. We compare that using your actual experience of your net of fee return on a rolling 10-year basis. And you can see that is a solid green line, and you can see there's a fair amount of time periods where your rolling 10 years far exceeds that actuarial rate of return. But obviously there's been periods of time during the Great Recession of 2008 and beyond where there's been periods where we did not experience that. On a go-forward basis, we think your probability of achieving success measured as beating your actuarial rate of return, is quite good. Again, 6.9% compared to 6.5%, which is what is needed to defease your liabilities over time. I mentioned that we benchmark. We set our assumptions on our own, but we do like to look around us and see what our peers are doing and other individuals in the industry, other practitioners in the industry. So what this looks at is a survey of 34 other investment consultants and compares what Aon is using as its capital market assumptions with that of the average and then the highs and lows, or the distribution of expected returns for various asset classes. I won't go into any great detail here, but what should be comforting to you is that we're reasonably close to what it is that many of our peers are doing in terms of expected returns. We're a little bit higher in some areas, we're a little bit lower in some other areas. All that tends to wash out over time. Okay, so asset allocation. What are the factors that we consider when we're setting that mix between 78% return seeking and 22% fixed income? There's a variety of different things that we think are important to look at. One is, what is the market going to give us? What do we think is a reasonable expectation? We just covered what we think that would be for all your asset classes. We need to understand what's available to us over the long run. We also need to understand what happens if we're wrong. So we spend a lot of time looking at downside situations to try to protect. We need to have inflation protection element within the investment program. We need to be very mindful of the costs that we're paying. Flexibility is incredibly important. We'll talk about some of the flexibility that we've woven into the program over the years. Diversification is said to be the only true free lunch in the investment world. We are big believers in diversification to protect you on downside risk. We'll spend a few minutes on that in just a minute. Liquidity needs is something that we've spent considerable time talking about with you, with the investment committee and your staff. As a partially or mostly closed fund, your liquidity dynamic is different than many of your peers and will continue to trend towards less liquid each and every year. You're negative cash flow right now, and so we need to be mindful of that when we invest in illiquid assets. And the last but not least, but really important, we can't set asset allocation that you don't have resources in place to manage. So you have a very strong investment team, you have a very strong custodial bank, you have a very strong operations apparatus. We believe you have very strong governance and oversight. Those are the necessary resources that you need to be able to diversify your assets in things like private equity and private real estate and other investments. So all that said, where are we now and what do we think we need to be doing? We think we need to be spending time on what happens if bad things happen in the US stock market and the global stock market. What are the tail events that could hurt us and how could we protect against that? And that's what we spent a fair amount of time talking about most of last year with the investment committee and yesterday as well. I won't go through every exhibit on this page, but there is something that I think is noteworthy to look at, and that's the upper right-hand corner. This shows the distribution of expected returns over a 30-year time period. Pretty reasonable, 6.9% is that center point. That's the return that I mentioned previously. We would expect 2/3 of the time that your return would fall between 10.5 and positive 3.5 over the next 30 years. Yes, that's a very wide range. We're dealing with equities and stocks and bonds and other asset classes that are volatile and very hard to pin down with precision. So when we have that type of a diversified portfolio, you tend to see this wider distribution of return outcomes. Shown in the table on the upper right hand side, or in the center of the exhibit, we can see U.S. equities, non-U.S. equities, and global equity. The role of those investments is growth. We need that type of investments to try to get that 6.5% rate of return. It is your single largest component within the investment program. We spend a lot of time there looking at how that portion of your investment program is built. Katie will talk a little bit about that when we talk about structure. I'll spend a minute on it right now as it relates to policy. Let me flip forward and ask you to go to slide 15. So last year, the investment committee, per joint recommendations from staff and consultants and the investment committee's desire, sought to move more towards a global-oriented investment program. Your public equities are 41%, or roughly $3.3 billion of your total fund, but they represent 90% of your risk. So we want to make sure we have very broad diversification. The exhibit on the left-hand side shows the global market, the market capitalization of the world stock market. Roughly 50 trillion in aggregate assets, and you can see the split between U.S. and non-U.S. 52% in U.S. stocks in the green, and then the remaining 48% in non-U.S. stocks, both emerging markets and developed markets as well. The exhibit on the right-hand side shows your policy exposure, board-approved asset allocations for those markets, U.S., non-U.S., and emerging markets, and compares it to the benchmark. The key here is that we've mitigated one of the risks, which is being different than the marketplace. You now look remarkably similar to the marketplace. We have a lot of indexation that helps us get there, but we also use active management to help add value beyond what it is the capital markets can bring us. I'm going to pause for a second, see if there's any questions about that. That was implemented late last year per the recommendations from the investment committee to the board and approved by the board and implemented last year.
A quick question. Is China in the developed or the emerging markets? It must be in the developed, I would assume, but
Yeah, China's included in the emerging market.
it's
Yeah.
in emerging markets, okay.
Yeah.
And your weight right now, I see Katie actually pulled up some detail on her.
It's about
Yeah.
it's about 3% of world market capitalization in China. And your portfolio with your active managers and the bets they take is just slightly north of that, around 4.5% of the total equity exposure to China.
Thank you.
What would be the top 5 countries in emerging markets?
China's certainly Korea,
Korea.
Taiwan,
Very good.
and India.
India.
Yeah. Oh,
So just as a quick side note, China continues to grow in terms of importance. It's obviously one of the largest economies in the world, second largest only to the United States. Very large population, very large GDP. Its weight is relatively small, so roughly 3-4% in the index now. That's starting to change. The index fund providers have been systematically increasing the weight of China as the Chinese capital market becomes a little bit more transparent, a little bit more liquid than it has in the past. And we would expect MSCI, FTSE, and some of the other providers to continue to monitor their exposure in the indices. We would expect that would continue to grow as liquidity improves and terms and conditions improve for that stock market. But still a relatively small player compared to the United States. Any other questions? So I mentioned that the long bull run that we've had over the last 10 years or so and the returns that we've had. Over the last 10 years, your investment program has generated a return of 9.5%, and you rank in the top decile of public pension fund peers, and you've generated a return 50 basis points in excess of your benchmark. It's been a fantastic time period for this investment strategy and the fund that's in place. We want to be mindful that that's not going to last. We want to be mindful that the next 10 years might be very different than the last 10 years that we've experienced. And so time has been spent thinking about what is it that what do we have in place today that can mitigate that downside risk? And there's just a few items that we point out here. One is that your fixed income is extremely high quality, U.S. government bonds and U.S. high quality corporate bonds of intermediate duration. That means maturities of 10 years and less. That's different from where it was 10 years ago. You had a fair amount of credit, you had a high yield, you had non-U.S. bonds. We want you to have a very conservative, basically an insurance pool for when things go bad. And treasuries and high quality bonds are the best way to do that. And that's the way your fixed income investments are allocated today. We've also been diversifying your return-seeking assets, using a lot of indexation, making sure you have that global orientation. But the last thing that I'd add that we've done over the years is the opportunity fund, making sure that we have flexibility to be defensive when we think we need to, or also look for dislocations when things get cheap, to be able to have the dry powder and the availability and policy to allocate to things that we think would be additive over time. And the opportunity fund has done just that and been very additive. What else can we do? One of the things that we've talked about with your investment committee over the past year is adding what's called managed futures. Managed futures are asset classes that seek to give you low correlations to traditional stocks and bonds. They don't behave like the stock market does. They offer strong absolute returns, typically with targeted volatility. Liquidity is quite good, oftentimes daily. In some cases with the investment vehicles that we'll be looking at, it might be as long as monthly. There are a number of participants in terms of investment managers that have been active in the space that we can evaluate that have very long track records. There's also some newer participants that we think have some compelling investment strategies to offer. And so the idea is to add managed futures to your investment program by way of the opportunity fund to seek to protect you on the downside. And just graphically, or in the table here, you can see on slide 19, by adding 4%, we moderately change the expected return from 6.91 to 6.98. We reduce your volatility slightly. But look at that last item, the 5th percentile return for 1 year. This is when things get really bad. what we would expect your policy portfolio to return, and this is some of that downside protection. We can't get rid of all of it. We need to take equity risk, and so adding managed futures at the margin of 4% helps us reduce that downside volatility slightly. You can see it again here on this exhibit. This is an interesting chart. On the upper right-hand side, we have a decomposition of your level of risk within your investment program, and that purple is your equity investments. That's about 90% of your total risk. 41% of your assets equal 90% of your risk. That's what we're trying to make sure we can diversify and protect when things go bad. The exhibit on the bottom side is a simulation analysis looking at over various economic periods, like 5,000 different economic trials over 1-year periods, and calculating different equity returns. That's the black line. So you could see sir.
Steve, I have one question about the prior slide, which is it indicated that one of the considerations was, maybe it was the one before that even, one of the considerations was that managed futures may suffer at market inflection points or in choppy markets, which just strikes me as inconsistent with low volatility and lowered risk. So could you just explain that?
Yeah, a lot. So we want to be fair and balanced, and we want to present what we see in practice and what we think could be reality based on theory. Some managers and managed futures have experienced kind of sideways returns or flat returns in choppy markets. Others have not. Others have generated strong returns. So a lot of this will have to do with good, strong manager selection. What we've been thinking about with the investment.
Lawyer made you put that line in?
We have a big compliance and legal department within Aon, and yes, they want us to be transparent, fair, and balanced. We've been spending a lot of time already looking at managers, and your investment team has visited with quite a few managers as well. And the idea is to bring you a set of candidates that will have some of these considerations, but seek to diversify some of that choppiness. Some of the managers we're looking at are fairly aggressive, and we want to counterbalance that with more conservative managers that we think can do well in sideways, flat or choppy markets as well. Thanks for picking up on that. It's actually a good observation. Okay, so slide 20. Slide 20 shows, again, that when things can go bad with equities, where can we hide? Well, we have the treasuries that we can hide in, and treasuries generally do quite well when equities do poorly. And you could see the blue bar in the lower left-hand side represents your policy return in a simulated 1-year environment when equities return negative 27%. We would expect your total fund, absent any active management, to return about negative 15%. When we add a small amount of managed futures in green, you can see that we change that from negative 15 to about negative 12.5 to 13. So what we're trying to do is we in our statistical speak, we're trying to cut off the tail end of the distribution. We're trying to lessen the impact of the worst things that can happen. And even a small allocation of 4% to managed futures helps us do that. I'm going to skip forward a few slides for the sake of time and wrap things up, and then Katie will talk about structure, and then I think at the end of that we'll open things up for discussion and for a vote. So when we look at the different areas that we want to make sure we're always mindful of when we're setting asset allocation, diversification, alpha, inflation protection, flexibility, liquidity, and downside protection. We basically already talked about all these things. You have elements in place right now that very successfully address all of those issues, all of those considerations. All we're recommending today is an increase at the margin of something that we think will help you more on that last item, downside protection, which is something that the board expressed interest in at the last meeting. So I'll stop there. Happy to take questions now, or we can move forward and talk structure. We'll probably spend about 5 or 6 minutes on that, and then we can take a vote on this item and one item in the structure piece.
Can I just ask a basic question I should have asked about 5 slides ago, but what are the underlying assets in the managed futures accounts?
Everything. And it's managed by way of futures and in forward contracts, so very liquid, daily liquid futures contracts. So it could be currency, it could be equities, it could be fixed income, it could be commodities. The strategies that managers generally look at are things like trend and momentum. And they're highly liquid, fairly frequently traded, and looking to try to pick up short-term and intermediate-term trends in the environment.
But because they're futures, because they're buying futures rather than current assets, somehow that reduces the tail?
No, they use futures for efficiency. Futures are very cheap for them to be able to purchase, and it gives
So
them
they diversify more by
massively
paying
diversified.
less for
These
the-
are highly diversified
Got it.
portfolios with hundreds, if not thousands, of individual positions of offsetting long and short allocations to different strategies.
Thank you.
Good question. Okay.
I have one, Steve. Should the managed futures of 4%, should that be in the risk-reducing part versus the return-seeking?
That's a great question. We spent time on that with the investment team. We spent some time on that with the investment committee as well. We have some clients that do think that way, that operate that way, and we don't think that there's anything wrong with that. We chose not to do that here because we wanted to keep our fixed income pure and simple. We wanted it Barclays, intermediate aggregate, high quality, high investment grade bonds. And I remember talking to the investment committee chair, Carol, about this. And at the end of the day, we want you to have that exposure. It almost doesn't matter where it goes. It fits nicely or nicer in your opportunity fund, given the nature and the structure of the opportunity fund. So we could see reasons going in your fixed income structure. We could see reasons going in the opportunity fund. And at the end of the day, we think the opportunity fund is the right place for it.
But if it's in the opportunity fund, that doesn't also mean you're taking away from future opportunity investment because you use 4% for a risk-reducing?
Yeah, we're mindful, and recall that there is a cap of 8% in the Opportunity Fund. We will get very close to that cap if this is approved today and if the investment committee selects candidates at the next meeting. We'll be very close to that cap, absent any other changes. Some of your investments in the Opportunity Fund will start to give you money back. They are intermediate to shorter term investment strategies, and they'll start to give you capital back, much like some of your private equity investments. So we do envision some elements of future flexibility and freedom where we won't be right up at that 8% cap.
Yeah.
Great questions.
Steve, how do you think about margin risk and collateral risk? I mean, these strategies will involve derivatives, and maybe you can touch on how that impacts the number of managers you're recommending for this allocation.
Yeah, so everything that's going to be traded would be exchange-traded investment strategies. A lot of it will vary by the individual investment managers, so it's a good question to save for the managers when they come. My response today is we recognize that is a risk that we want to try to protect and control against. The managers that we will bring you will have gone through a very thorough vetting of operational due diligence, including on-site meetings, looking at their operations and looking at how they trade their portfolios. And yes, we will most likely be bringing you 3 candidates for this 4% allocation to give you what we think is maximum diversification without sacrificing fees and increasing complexity. Good. Okay. We're going to switch gears from asset allocation, and we're going to talk about portfolio structure.
Great. Good morning, everyone. So portfolio structure, we're going to peel back another layer of the onion and get a little bit more into the weeds, but not too much. So portfolio structure, we're talking about the implementation or the execution of the asset allocation that Steve just went through. And this is important because it ensures that the asset classes are serving their intended purposes. This refers to decisions such as the decision between active and passive management, where to use active management, the styles and types of active managers and their selection, the overall cost structure of the program. And then most importantly, when you take all those pieces and put them together, how do they work together? You can have 2 very successful individual pieces, but when you put them together, if they're canceling each other out or offsetting each other, that may not be what you want to see. So we went through, similar with the asset allocation, structure review yesterday with the investment committee. It was roughly 75 pages. We don't have that here, but I do want to highlight some of the things that we went through and their overall take on the portfolio structure. Similar to asset allocation, once we set this and it's vetted, we don't anticipate this changes materially or frequently as well. So we have one minor recommendation today, but otherwise we continue to think that the overall structure of our portfolio continues to be appropriate, is risk controlled, and is efficiently managed. So we flip ahead, we have some core beliefs or key attributes that we think are important and that have helped us set and get the portfolio where it is today. We think that these are the key things that are successful to your portfolio structure, and I'll go through these briefly here, but these are the themes that you'll see as if you look at the underlying building blocks to the SDCERS portfolio. One is getting exposure to the broad opportunity set. We don't want there to be any biases in the portfolio that we are unaware of and that may present some undue risk or unknown risk to the portfolio. We want to pay little for beta or little for index exposure. And so that means focusing on active managers that are going to truly add value and being very conscious with where you're spending your active manager fees. This goes into selecting active managers and only utilizing active managers where you think there will be true alpha and focusing that selection on their skill and not necessarily trying to fit them into a specific style box. We use an active risk budget. This is something that we work with the investment committee on and we review on a quarterly basis. And so we're not only looking at the dollars that we allocate to your investment managers, but what's the active risk or what's the risk that they're contributing to the portfolio, and want to ensure that that is balanced and that there's no concentrated risks there as well. And then lastly, being very cost conscious, keeping fees low and making sure where you are spending your fee dollars that they are being rewarded or that you have conviction and belief that those will produce alpha. So we've included here, a lot of work has been done. The next 3 pages, which I'm not going to go through, you can see a lot of work has been done over the past 9 years, just by the magnitude of the words on these pages. But I want to land on page 29, where we tried to summarize some of the key data points here where the portfolio stands and can exemplify these themes that we have worked to put forth in your portfolio. And so a few of the statistics, one is the information ratio, which is kind of right in the middle of that table there. And what this is looking at is the excess return of these asset classes over the tracking error, over the risk that is taken. So it's measuring the skill of your active managers together on a risk-adjusted basis and looking at the consistency of that skill. So if you look down across the publicly traded asset classes, you can see it's mostly positive across, and these are over the since inception of each of these asset classes time periods. If you look a little further to the right, we show the active-passive mix. And so one of the things that we have looked at is being very deliberate with where we employ active managers. And so you can see that in some of the less efficient markets, we have a meaningful exposure to passive management. And this has allowed you all to get efficient exposure to these markets at a very low cost. And so we've included the aggregated fees here as well. And if you look down the board, your investment team and the investment committee has done a very nice job of keeping these fees low and still being able to generate alpha in each of these portfolios. Along those lines of being very deliberate with active risks and using passive management where we think it makes sense, that's also allowed you to focus some of your active management and where we believe that a significant amount of alpha can be had to your alternative asset classes. And so those are the bottom 4 rows. And so some of these statistics aren't appropriate given the illiquid nature of these alternatives, but we can point to the returns that you all have generated since inception in these asset classes. And so you can see from real estate, private equity, infrastructure, and the opportunity fund, they have generated nice returns since inception between 9 and 15% annualized. And then their excess return, they've generated a return above and beyond their benchmark as well. So the overall, the program is continually managed in a very efficient, risk-controlled, and efficient manner. And you can see it shines through when we look at some of these important numbers here. So went through this very quickly. Want to wrap up on some of the things that we focused on and that you all have focused on over the years to get the portfolio where it is today, which we think is in a good place. You have a meaningful allocation to alternatives, and that has been very successful in generating some strong absolute returns for the portfolio. Across your public markets, again, have been very efficient and deliberate with where you're taking active risk and the active managers that you've selected. A very diversified portfolio. Steve had mentioned that the public equities are now globally diversified, which is, we think, the best way to access those markets. Passive management and being cost conscious have led to a very efficient portfolio. And then we've also continued, obviously, to focus on just selecting those highest conviction active managers. And you can see in the return numbers and the alpha that the portfolio has generated that you've been successful there as well.
Katie, have all of your clients done this well?
Only you.
Suppose by definition, no, given where you rank in
Yeah,
the universe, you're at the 5th percentile. So
Not only that,
You're
yeah.
almost peerless in terms of your performance.
And from a risk-adjusted measure as well, which was an addition to our performance report as well. So you're generating nice return for the risk that you all are taking, which is a direct result of all of this work that you all do on an annual basis. So the one recommendation that, as we go through this process, one recommendation that we do have is to consolidate two of your indexed funds in the U.S. equity portfolio. Currently, there is a large cap index fund that represents the S&P 500 index and one that represents the Russell 1000 index. And by consolidating those, you're not losing any exposure to the markets, not changing any of your risk return profile, and will actually be saving some modest fee dollars there. So this is, a very modest tweak, which we think will just make the portfolio a little bit more streamlined. You'll lose a line item there, but without losing any market coverage or, modify the risk return profile of the portfolio.
We should point out, this is something that when we work with your investment team, it's a collaborative process. We send thoughts and suggestions to the team. We get on conference calls. And this is something Anders pointed out, that, hey, it looks like we can consolidate, save fees, save custodial line item fees by moving from the Russell 1000 to the S&P 500. So you mentioned at the outset, Val, the importance of the team, and we would underscore that and agree. So that's it. So there are two recommendations before this group today. There's what Katie just mentioned on the structural side, and then there's the managed futures on the policy side. And that concludes the remarks that we had. And happy to take any questions about any items in the presentation or hear any of the comments or questions that any of the committee members might have from our deliberations yesterday.
Questions? So we will be voting on these. Obviously, we're largely status quo in both these areas with a few small changes. But really, that's a testament to all the excellent changes that have been made over the last 6 to 8 years, or however, maybe 10, from good ideas from our consultants, from our investment staff, and our board members, like people like Bill, who've been very involved in investment committees. So we're in good shape, and we're just, as you mentioned earlier, this is a long-term process. It's not something you tweak every year, and we're in pretty good shape. So we're ready to vote, and we'll just do one and then the other.
And the committee vote was unanimous?
Yes, the committee vote was unanimous.
So this can be done as a consent item, or do we pull?
Oh. What?
I think you can
How does
do
that-
A through D on consent, right?
Sorry, I don't know how that works.
No, we have to do them one by one.
Do them one by one? Okay.
Do them one by one.
Not even off the board, and they're overruling you.
Help me out.
They're probably right.
Okay, so, but I can make the motion, right?
Yes.
Is that how it goes? So can we,
Well, George Kenny already did, so.
okay, so I will make the motion. What? Did that work?
No, you don't have a button.
Oh, I'm in the wrong place. I'm sorry. Get with it, Carol. Holy cow. Okay, there we go. Second not required. Okay,
Ready to vote. All votes are in.
and that passes 13-0. Thank you. And next we'll do the structure, portfolio structure and implementation. I will move that.
Ready to vote. All votes are in.
And that also passes 13-0. Very good.
Fantastic. If I could just make one quick comment and underscore the comments that Greg mentioned at the outset, and thank the rotating trustees, Val, Bill, and Tom. It's been an amazing time period. The $3 billion, $1 million a day, truly remarkable. I looked back at the history of the fund, and this is the single largest run in market value, net of benefit payments and contributions ever. And so truly a remarkable time period, and you're leaving this investment program stronger and better than when you first got here. And we've truly enjoyed working with you, and thank you for your oversight and governance. Appreciate it.
Thank you, Steve and Katie.
I'd also like to thank you because we've been very fortunate to have professional staff, our staff here, and advisors with you. And that's what's allowed us to get to where we are. So thank you so much.
Okay.
Okay, thank you, appreciate it. I'm telling Val, let's go ahead and finish up the final action item from Investment Committee, and then later on, we'll just do reports. And this, very briefly, is a recommended change to SDCERS proxy voting guidelines. There are two recommended changes that we worked with our proxy vendor on. They're reasonable and not really subject to controversy or discussion. So the board or the committee approved them unanimously, and I would like to then move to approve them here at the board.
Ready to vote? All votes are in.
And that passes 13-0. Thank you.
Carol, you have only staff reports left. Do you
Yeah.
have anything to do on that? I mean, do you want to finish your report now? And if you wish, up to you. We'll come back to you.
We'll come back to it.
Okay.
Let's let the big guys go.
All right. So next item on the agenda then is we're returning to regular order, and it's the Audit Committee and Bobby Spoon.
The Audit Committee met on Wednesday. We had one action item. Sarah Dixon proposed the Information Technology Audit Plan, and she asked for an amount not to exceed $50,000 to prepare the plan. The committee voted. It was a unanimous vote, and we recalled that when we replaced Lee, we definitely wanted someone that was more skilled in the audit area, and we knew that we would hire consultants to do the IT audits. So this is consistent with the plan of the committee. So we voted unanimously to approve the $50,000. And this was sent to the B&G committee, which met yesterday, and also unanimously approved it. We had two non-action items. One was to hear Sarah's report on the health insurance cost recovery audit, and then we also had a discussion regarding the audit committee roles and responsibilities, and we defined the calendar for the review of the CAFR, which will come later this year. We heard status reports from internal, or we received the written reports from internal audit, IT, and legal. And following Tanasi's lead, we had no discussion on those. And that's it.
Thank you, Bobby. That next brings us to the business operations section of the agenda. And here, our action item is the June 30, 2018 actuarial valuation. And approaching the podium are Jean and Alice to make the presentation.
Gene, could you say something nice about Val before he leaves? Do you mind?
I'll try.
Thank you.
Thanks. Glad to see you coordinated your tie with your clothes today.
Good morning. So while Alice is getting hooked up here, just a reminder, every March we come in as a second shot at presenting the valuation results. In January, we presented the full results, and now we have a shortened version with the same results. And we cut out some of the information, but left some of the more important items in here. So you know that you've lowered the discount rate to 6.5. It's been already mentioned this morning, and that resulted in higher costs and liabilities for the plan, as well as the members, and the specific salary increases that took place that were negotiated are shown here in the table. And I want to point out that it was pointed out to us a few days ago that the January 1st, 2020 increase for police was not 8%, but 5%. But we do not want to change the valuation results because there was a whole group of additional special add-ons that weren't reflected in the pay increase, and that will just offset this amount. So we'll stay with the same. Next chart shows the discount rate for the roughly 128 plans that are in NASRA's database, the largest plans in the country. And if you look to the far right, in 2018, you're in that group of 14 plans that have a discount rate of less than 7%. And you could see nationally how back in 2001, everyone was, not everyone, but most of the plans were at 8%. So this has been a national trend. You've seen that before. As far as historical trends, the next chart shows your comparison of your assets and liabilities. We're showing assets on a smooth basis and on market value. And you can, if you look at the two lines, whenever there was a market decline, you see how the gold line held up assets higher than what the market crash was, like in 2008 and 9, and also earlier at the 2001 period. You're at 70.8% funded, but you're nearly 74% funded if you looked at market value of assets. The next chart compares, we took the 128 plans in that database and converted all their liabilities to a 6.5% discount rate.
Thank you.
They probably don't like it. But you're that gold dot, and you could see going to 2009, you're in that lower quartile. The light green is the lower quartile, the dark green is the next quartile, and in between the dark green and dark blue is the median, and the light blue is the upper quartile. And you can see where I'm looking at my chart. Okay, where you stand today, it's different from what I have. So
Top 25%.
slightly different. But you're approaching the upper quartile, and that bodes well when you compare yourself to largest plans in the country.
Let us never use the largest plans in the country as our yardstick.
Well, next time we'll show you the smallest plans in the country. It'll be all over the place.
I mean, I would like to say I'm in agreement with Val. Misery loves company, but 70% is a terrible number.
Okay.
But there's tremendous progress when you take out all the variation in the assumed rates of return, and you just look at it in terms of how we're doing compared to how we were doing. What's important to me is we've made great progress.
Yes. And given that establishment of that UAL floor, you've got a great safeguard going forward. This next chart shows the gold bars are the amount paid by the city, and the dark blue and green are what we determine as the actual contribution. The green is the normal cost. The dark blue is the UAL payment. And you can see for the past 14 years, or ever since 2006, the city has paid the exact amount or even more than what the actuary determined. And the years prior, that's during the MP years, the city was underpaying. The next chart shows annually the patterns of gains and losses. The gold bars are investments, and the blue bars are liabilities. This is annually, how did the experience stack up against our assumptions? You can see how severe the 2008-9 market crash was. One of the interesting things that we're noting, if you look for the past 6 or 7 years, in the blue bars, there have been little drips of losses every year. Those have been largely due to salary increases greater than expected. The next experience study will take a closer look at that. So, Bill, you've asked the question over and over again, if we're doing so well, how come the unfunded liability has grown so much? And since 2007, the unfunded liability has grown by $1.8 billion. And what contributed to that, 1.4 of that 1.8 is due to assumption changes, so you strengthen assumptions. And then it was just under $1 billion, or 900 million attributable to the experience, largely the investment loss, but then that was offset by the fact that benefits were paid and contributions were made, and that's the gold bar and the red bar. Alice will take you through the Unified Port District and the Airport Authority.
So, stepping through the similar slides for the city, as we did for the city, looking at the historical background for the port, we see a similar pattern in the funded ratio over time. With that 2009, we see that the asset line dipped significantly compared to the top of the bar, the liabilities. So the funding ratio dropped from 2008 to 2009 to the 77.5%, steadily increased over time, and then it was in 2016, as a reminder, was the last experience study, and firming up the mortality assumptions, the liability increased, and the funded ratio has been hovering in the 74% range. Contributions for the port, the contributions have consistently come in as calculated by the ADC, so the port is meeting the actuarially determined contribution year over year, as shown by the gold bar. Very similar picture here in terms of the investment gains and losses and liability gains and losses. The investment gains and losses certainly fluctuate more in the period shown than the liability gains and losses. And on the liability side, it shows that the assumptions really hold true to actual experience coming through. When we look at the change in UAL for the port, in 2007, the UAL was at 16 million, and in 2018, the port's UAL is 149 million, so that is an increase of 139 million. Largely due to changes in economic assumptions. So the black region there, the economic assumptions increased that UAL by 67 million and the demographic assumptions by 25 million. So the assumption changes alone made up 92 million of that increase in the UAL. As for the Port Authority, their funded ratio, which we see time and time again, we point out that their funded ratio has remained higher given their internal policy of making additional contributions in times when the funded ratio drops below their trigger marks of 95% or below 90%. And so they've kept the asset line higher, closer to the top of the bars to the actual liability for a funded ratio this year of 89%. We see those additional contributions in this graph wherever the gold bar exceeds the makeup of the ADC. Those are the additional contributions that the airport put in addition to the actuarially determined contribution to make up for that funded ratio drop to stick with their policy. When we look at the airport's gains and losses, we do tend to see more fluctuation, but that's because it's a smaller plan, so any movement has a higher percent relative to the entire asset or liability results.
But once again, when you look at it from the date when Bill Hayner came on the board, there's not really much of the investments have all been good, the volatility's gone.
You know, I had a quick question here. If you take 2009 and each of the three, the port and the airport authority, the 2009 is down 16% in one, and I think it was 18 in another, and I don't know what the other one, what ours was. It was different. I'm surprised at the differences.
Those aren't returns. It's really just what's the loss as a percent of the assets, but the actual return has got to reflect cash flows and things, so they wouldn't be the same numbers.
Mm-hmm.
Oh, okay.
Yeah. And the airport's UAL buildup since 2007 has been similar to what we've seen for the port and the city, in that the demographic assumptions and economic assumptions have led to the UAL that they're seeing. So their change from 2007 to 2018 is a $26 million increase in that unfunded. Gina will take it back.
The next slide shows the key valuation results, and there's the last year's results, which is the 2017 actual, and then next column is what we would have expected if you kept the discount rate at 6.75 and where we actually are today at 6.5. I think some of the key aspects you can focus on, the third row down, average salary went from $70,271 to $76,379. That's an 8.6% average increase from the prior year. The unfunded actuarial liability increased by $200 million, but if you look at that row in the gray area, unfunded actuarial liability, without the discount rate change, your unfunded liability would have dropped from 2.75 or 76 to 2.61. Now it's at 2.977. And your funded ratio on a smooth basis, 70.8, and we're now at we are at 73.2 if you look at market value. Finally, the actually determined contribution for the city went up about 33 million from 320. No, actually, it's 322. That's more than 30.
Yeah, 27 million.
27 million. And the reasons for that are in this table on the actual liability. We expected liabilities to increase by 226 million, and they're actually, due to mainly the salary increases, an additional 115, and then the change in economic assumptions increased it to 274. Finally, the miscellaneous kind of, if you look at the liability and the assets, there's additional liabilities due to PSC and drop, but there's also additional assets, so they offset each other. So at the end of the day, again, the ADC largely increased because of the salary increases and the economic assumptions that pretty much made all of it up because of the other items are negative. So that concludes the results for the city. Alice?
For the port, taking a look, so I always actually have this slide handy at all times. It's a good snapshot to give you the results in one spot. It is a lot to look at all at once, but in terms of some key items for the port that I'd like to point out, so in the middle there, the actuarial liability at $577.8 million, that actuarial liability increased by 7%, and the actuarial value of assets also increased relatively by 7%, and that's where you held that constant funded ratio. In 2017, the funded ratio was 74.3%, and this year, 74.2%, so held pretty steady there. As for the ADC, this year's ADC is coming in at $19.3 million, which is up $1.4 million from the prior year, largely due to the assumption change.
Alice, is the difference between the actuarial value funding ratio and the market value funding ratio just a function of the smoothing?
Yes, yes. So there are gains to be recognized in the coming years on the actuarial value of asset side. Mm-hmm. And seeing the reconciliation, you could see how the liabilities changed from one year to the next, stepping through the assets, and how that translates to the UAL and how that builds into the ADC. So again, the main component of change in the actuarially determined contribution was the change in economic assumptions, which increased the ADC by $1.2 million of the total $1.4 million increase. When looking at the airport authority, their average salary, if we look in the middle there, the average salary increased by about 4% for the members, and they had a slight decline in their active population. In terms of the actuarial liability to assets, they had a similar movement. They both increased by just over 11%, and so the funded ratio stayed relatively constant, moving from 89.2% to 89.0% on the funded ratio. You'll notice in the ADC, the components of the ADC for the airport appear different than for the city and the port, in that their UAL payment is not the largest portion of their contribution. It's the normal cost to the employees, and that UAL payment is at $1.37 million for the total ADC of $6.159 million. The reconciliation of the results from 2017 to 2018 valuation, going straight to the ADC column, we see again that there was favorable asset experience, And the airport actually had favorable liability experience, so meaning that they had a little bit of gains on the liability experience side, but that was offset with the change in economic assumptions, which increased the ADC by 770,000 for a total ADC of 6.159 million, up about 400,000 from last year.
So we'll conclude with the projections, and I've got good news and bad news. Actually, that is
First,
that's the wrong.
the good news.
It's the wrong.
I think we loaded
Sorry,
the wrong.
I loaded the wrong. I
PowerPoint.
apologize to my machine.
The PowerPoint that she put up there didn't have the good news. I'll just tell you.
How about I switch to the model and then?
Yes.
And then.
We'll just stay with the model.
Sorry about that.
So if you look at the top, the plan arrives at full funding at 2034. If you recall, at the January meeting in the board retreat, the magic number was 2037. That's the good news. The bad news is this picture Marcel has on her office. It says that the problem with the valuation results in these projections are they're never right. Meaning we're going to have varying experience. So we'll put in Greg tells us it's 2.8% for the year, and we'll put in 2.8 for the first year. And now we're back to I can't see it. Is it 2036? 2036. So it's a moving target, but.
Fix it.
Okay. Alice, put in 15%.
Yeah.
It's fixed. But the board had gone through
Wasn't it Mark Twain who said there are lies, damn lies, and statistics? I
Yes.
think that applies to actuarial science more than anything else I've ever seen.
I would agree with you. But unless the board wants to go through a lot of additional projections, we've done a lot of this in January and at the board retreat, which frankly I think was, in my career, the best board retreat I've ever been to. That was just thorough, and we arrived at a great conclusion with this UAL floor. And again, I want to thank the board and I wish Val and Bill and Tom good luck in the future, but your stewardship here has been very much appreciated, and I hope to see you guys again.
Thank you, Gene and Alice. You guys are terrific.
Thanks.
Thank you.
All right. Should we take a short?
We need a vote.
Oh, we got to vote on the action item. All right, so let me make the motion to approve the 2018 actuarial evaluation. Yeah, who knows how it's going to come out?
I need a mover in a second.
We need, oh, and maybe I'm not in the right place.
Ready to vote?
I am. Thank you.
All votes are in.
All right, and that carries unanimously. All right, let me just look around. Do we need to take a break, or shall we plow ahead?
Excuse me.
All right, let's take 5. I just Well, it's kind of like the last time. Okay. All right. Back on the record, as we say in court. We're on to the Disability Committee and Charlie Hogquist.
Good morning. I'm going to take the items a little out of order. We're going to start with item A2, which is the staff's recommendation to approve the industrial disability retirement of Andrew Sorby. And staff has recommended the approval. And during our committee vote, we did vote to approve it 5-0. Any questions?
Charlie, do you want to do consent for 2, 3, and 4 together? And then we'll pull 1?
That'll work perfectly.
Thank you.
Okay. Okay, and then item 2 was a recommendation to approve the industrial disability retirement of Greg Goodman. Again, it was discussed in the committee, and it passed the committee 5-0.
Mr. Goodman would appreciate if no one pulled that from the consent agenda.
Especially since he's in the back of the room. And item number 4 was the, I don't have it, you can't read it there. Here we go. Got it, okay. And 4 was staff's recommendation to grant Richard Reichner's request for an extension time to complete his disability retirement application. We do have a timeline for that. We did have some discussion, and again, we all voted to approve it 5-0.
Move it.
So go ahead and move the consent.
We'll move the consent item.
Ready
Okay.
to vote?
Please vote.
All votes are in.
Okay, and the motion is passed 13-0. And we also had item B1. Which was our, okay, thank you.
Charlie, with the SDCERS system, it won't let us move to B until we finish A1. So would
Okay.
you mind doing Mr. Armstrong's
Okay.
application now?
Okay.
Thank you.
Okay, we're going to move to item A1, which is staff's recommendation to deny the industrial disability retirement application of Scott Armstrong. Is Scott here? Would you like to speak now, Scott, or wait till we have our discussion?
Hey, Charlie, didn't that say with prejudice?
Without. Okay.
I never worked with Officer Goodman, but I did work with Andy Sorby, so thanks for approving his retirement. I'm sure Andy would probably have preferred to work out his whole career because he was that kind of guy, but his job was, he got pretty beat up on the job, so I get it. I just wanted to I think a lot of you probably haven't heard me speak, so I just wanted to go over what's been my experience here. That I think in 2011, I applied for disability retirement. Even though I was told I couldn't, I did it anyway. The municipal code was written to deny just out of hand my disability retirement, even though all the city doctors said that my disability was fully industrial. Went ahead and did that, and that was denied. I ended up with a non-industrial retirement, which, as everybody knows, is the same as if, I like to always say that if I destroyed my knee skiing and couldn't go back to work. So I'm getting that retirement benefit for a work-related injury. So there was some pretty good discussion yesterday. I really appreciate everybody's efforts and thoughts and attempts to make it right. I know a ballot measure went to the people last November after many years of work by, I think Todd Gloria kind of started it. And I don't know who it was handed off to when he left, but it went to the ballot and somehow got watered down to the point where I don't think it's really going to help that many people. It did make some changes, but I don't know that it really did a whole lot. It didn't help me, which we kind of knew it probably wouldn't anyway. But I'm here anyway just to remind you that I have a face I'm a person, there are other people like me. My type of injury is not one that people like to talk about, especially in the police department or the fire department. So there are probably a lot of people out there who are dealing with stuff that I was dealing with, who aren't willing to come forward and are just trying to work out the rest of their careers and make it to their retirement without, getting themselves killed or somebody else. I hope that some more of them come forward so this becomes a little bit more of a prevalent issue and the city council has to deal with it more than they already have. But that's kind of where I'm going to leave it for now. I just thank you again for any consideration or discussion. If nobody has any questions for me, I'm going to go sit at the back table again. But
Well, thank you very much, Scott. Anybody have any questions for him? Okay.
I don't have a question. I just want to thank you for being a voice for this issue. It's not going to go away. It is a real issue that the city council does need to address. I lost a lot of sleep over this last night as well, being a member of the committee that voted to deny this claim. It's one of those situations where we're correct by the rules, but we're wrong in the grand scheme of things because of the way the rules are established here. And I just want to speak that to the board as well.
Okay. Any further comment? Yes.
Yeah, I'd like to say I totally agree. Unfortunately, the rules are, they're old, and they were probably made at a time when this disability was not universally recognized in other areas. And so I'm very sympathetic to this, and I hope the city council changes their mind.
Yes, Tom.
Yeah, I sat in yesterday on the discussion regarding Scott's plight, and I know that there have been certain changes, and I know that the board and the committee is hamstrung with the way everything's written, but I know that the board or the committee would have voted for you had they not been with their hands tied. So just let it be known you're doing a good service for future, and hopefully it gets corrected so that your service is not discounted in any way. You did a darn good job.
thanks.
Any further comments? Okay, well, thank you, Scott.
One comment, and Scott, you can move if you'd like. This isn't really a question to you, but following the vote to deny the application, we did have a subsequent motion, which the board will get to see, to write a letter, to have our CEO write a letter to the city council to ask for their attention to this injustice and that they take some action to correct it.
Yes. Yes, our discussion yesterday went rather long. We actually impinged on Tanasi's time. But it was a very robust discussion, and we did discuss the fact that the new law as passed does not directly cover Scott's injury. And as a result, we did vote to deny his disability retirement without prejudice. The vote was 4-1, and that leaves other legal obligations up to him. And then we have a subsequent motion, a second one after we deal with the first one, where we're going to discuss having the CEO send a letter to the city council to have them reconsider the language in the ordinance so that Scott can reapply and that future firefighters, police officers, and other city employees who do suffer this type of a traumatic injury are covered by the retirement rules. So we'll have to take item number 1 first, the staff's... Oh, pardon me, Jeff.
I just want to let the board know I'm the lone no vote, or I voted against the motion. The reason being, the facts are Mr. Armstrong is disabled, it happened on the job, and yes, the municipal code says that's not covered, which was later revised. I believe that's what I read in the material. So after reading it, it just sounded like he had the wrong injury at the wrong time, and sorry, we can't grant you the disability, and that just didn't seem like the right thing. And we often have these votes that you have to weigh in what's the right thing versus what we're supposed to do, our fiduciary duty. And for this one, for me, it felt more on that I should do what I feel is the right thing to do, given his circumstances. And so that's why I voted against the recommendation. And and after hearing some comments yesterday, I believe I still feel that way, that I'm going to vote against recommendation, and unless I hear something more substantial to sway my mind, that's just the way I feel.
Thank you. Tanasi.
So two things. We did amend this motion to add without prejudice, and I want to be really clear about that because I think the rest of the board needs to understand it, and I also think that there should be a record of what the intent of that was. So first of all, by adding that, what we're saying is that while we're denying Mr. Armstrong today, that it doesn't prevent him from reapplying for that later. And the reason for that is we are specifically hoping that there will be a change either to the municipal code or to the city council so that it would allow him to come back and reapply. So I want to be really clear that has been changed. And in doing that, I think the board has done everything it can possibly do to keep that issue alive. The other important thing, just so you understand, that vote today allows Mr. Armstrong to go off and do whatever else he might be able to do. Not doing it, delaying it, or tabling it, which were all discussed, prevents him from sort of getting some closure and then taking whatever steps he wants to take. The last issue I will just mention in comment to Jeffrey's comment, and only because I think it's important for the rest of the board members to know that, is that fiduciary counsel on the phone yesterday, and I'm paraphrasing what he said, was saying that to the extent that we vote against the municipal code or we do not follow the law, we are potentially breaching our fiduciary duty. And he even made a side comment that said, I don't throw that term around lightly. In lawyer speak, what that means is, hey, really pay attention to what you're doing because this is an issue for you guys. And as you all are well aware, we don't get paid. We don't get a pension. We if we do things well, Joe Flynn shows up when we retire and tells us what a great job we did. Maybe a couple of retirees thank us, but the reality is we expose ourselves every day to personal lawsuits. It's happened on this board before. If you do the wrong thing, if you don't follow the job, you don't do your job, you run the risk of getting sued and losing substantially your own personal wealth and fortune. Why do I say that? Because it's a thankless position. And so it's, while the committee, I think unanimously, as Tom said, would absolutely have voted in favor of granting the disability benefits to Mr. Armstrong, I think we're prevented from doing that. So anyway, thank you.
George.
Yeah, maybe I'm mistaken, but I thought this board has the power to overturn this and to grant it. If so, I'm not making a motion, but if so, would that send an interesting signal to the city council?
Unfortunately, the signal would be that we're a lawless body because the law is very clear. And adding to the administrative record for some legislative history for some future legal action, I understood, and I think I proposed the words without prejudice yesterday in the meeting, and what I understand that to mean is that this motion can be renewed at any time should there be any change in fact or law. And number two, as far as I'm concerned, and number two, I intended that to mean that if there is ever a benefit, industrial disability benefit granted, that it would be potentially retroactive, not just prospective. So that was my intention in saying without prejudice. And I just want to make sure that when the board votes on this motion, they understand that intention.
Any other comments? Okay, then we're ready for a motion.
I think you make it.
Yes.
Ready to vote. All votes are in.
The vote passes 11 yeses, 1 no, and 1 abstention. Okay, let's go to our second motion. And as a result of our discussion yesterday, we did want to make a motion that Tanasi made to direct our CEO to send a letter to the city council speaking of the limitations. And may I read this?
Please.
We have some draft language here that we'll do, and we want to discuss this. And basically, the motion would be to direct the CEO to communicate to the city council the limitations in the municipal code addressing disability benefits suffered benefits to members who have suffered significant mental injury as a result of a violent attack involving the use of deadly force who did not also suffer great bodily harm. The communication would be, use an example of Mr. Armstrong's industrial disability benefit denial and a request to expand Municipal Code Section 24.0501, subsection D, the disability benefit eligibility requirements to include Mr. Armstrong and others in a similar situation.
Does the motion as read reflect the same wording as what's on the board?
No, it's slightly different, but just grammatically, and then the term invite versus direct, so it's slightly different, but
Okay, so
otherwise it's exactly.
Okay, so we're voting on the motion that's on the board, and there's a very slight difference between that and the written, or the version just read. So everyone should look at what's on the board, familiarize themselves with it, and that's what we're actually voting on.
You know, I think there's an issue with the date, isn't there? Mr. Armstrong was hired in '99, and doesn't the municipal code right now say for employees hired after 2000?
I believe it's the injury occurred.
It's the date of injury.
Well, there's still an issue with the date.
May I address the board? And I think that is the whole center point of the argument, is underneath the current municipal code and the current plan benefit rules, Mr. Armstrong is not eligible. And so what we would like to do is to communicate the disconnect with the city council for them to reevaluate what the benefit package should be to the employees, and so that they can reevaluate what the rules should be.
Who makes this motion?
In addition to including the definition of disability, to also eliminate the date.
You mean have no, Marcel is...
So this is a statute that was in the municipal code at the time that Mr. Armstrong was injured, and his dates fell within the original municipal code. It had a sunset date on it, and what was done recently was to reenact it. So he does fall within the proper dates.
Yeah, the issue is the definition of what is great bodily injury. And the traditional method that's used in the police world is you got to break bones, show blood, go to the hospital. And mental traumas have not been, or not covered under this definition that's used. Yet, as we've learned, many people suffer injuries from assaults and attacks that don't always have a physical harm, but do in fact incapacitate people from their ability to function as they were. And that's part of what we need to address here, is the fact that we have somebody that was attacked by somebody who wanted to kill him. In the ensuing struggle, he had to use deadly force to protect himself, and over time, that takes a toll on people, as we can tell. And we now have this black hole in the law that says we can't help somebody who is out there risking their lives to protect us. And I think of firefighters who run into buildings, and police officers, and even our lifeguards and other city workers who do these things without hesitation. And I think we have this obligation to encourage the council to do the right thing by these employees.
We also have an issue that Marcel spoke to me about after the meeting yesterday that I was not completely familiar with, which is that the revision of the law that passed, I think, in November of last year, the change to the Muni Code had to be put before the voters and approved by the voters at the November election. And so there is an issue as to whether the city council can make the modification that we're suggesting that should be made without resubmitting it for a public vote. I think that every effort should be made by the city council to consider whether there is any financial impact from this change at all. I believe there's not. And if there isn't, then I believe the city council can act without resubmitting it to the public vote, provided they make the appropriate findings, which I think they probably can make. And so, I would love to see this short-circuited, because this is obviously crying out for a solution, and it shouldn't require that it be resubmitted to the voters unless that is clearly required by the law. And I suspect they could make findings that would allow them to make a minor modification that would assist in this kind of a case, and that would allow us then, or you, because I'll be gone, to revisit this issue and grant the industrial disability retirement benefit and do it retroactively. So that's my hope.
Any further comments or discussion? Okay, I'll make the motion then.
Ready to vote? All votes are in.
And the motion passes 12-0 with one abstention.
That was a technical one.
Excuse me, Mr. President, can I make a parliamentary point of order? And per our board rules, when someone abstains from a vote, so on this item and the item before, they're supposed to give a reason why they abstained from the vote.
Then let's start with the vote before and ask George Kenny.
I don't agree with the rule. And I think that the city council should change it, so I'm not willing to support that motion. It's a political protest, if you will.
Thank you.
And I'll speak to this item. In my current capacity, I may or may not be involved in conversing or discussing this item once it does appear before the city or the city management or the city council. So,
Scott, you should be glad that he abstained.
Okay, thank you. Okay, we have another item for consideration. We have an affidavit and an action to deny, I should say withdraw and suspend the disability retirement benefits to Loretta Cooper. Loretta Cooper has become incommunicado, has not been responding to requests for her to resubmit her application. She has been receiving disability benefits, but as she is not of the legal age to retire, so she's required to do this once a year. And attempts to contact her have been unsuccessful, so we're hoping that by suspending her disability and pension benefits, she'll come forward, contact us, submit the affidavit as required, and then she'll get all the money that's coming to her. Any discussion on the item? And this was passed by the committee 5-0. I'll make the motion then.
Ready to vote? All votes are in.
And the motion is passed 13-0. And I believe that ends Disability Committee report out. Back to you, Mr. President.
Thank you, Charlie. At this point, I think, I suspect that Tanasi would like to skip over business and governance. Is there anything to report out?
Well, I'd like to do it formally, if you don't mind. Can I? All right. So the Business and Governance Committee met yesterday. We're gonna put the consent items up for a vote. I'm going to pull item number 2 because Johnny screwed up. He made an error in his in the motion and in the materials, and so therefore he had to do an audible yesterday. And so as a result of his error, we're going to delay my meeting and inconvenience all of you people. I'm sorry. With respect to the rest of it, the definitions are so extremely verbose and long-winded that I'm going to, unless somebody wants me to read the title of items number 1, 3, and 4, I'm going to leave that up to you. And I do that with great authority because under the board member responsibilities and core competencies policy. Item number 5, preparation, states all board and independent non-board members should come to the board and committee meetings having read all materials and having asked any questions to staff necessary to complete their understanding of the materials. And I know you all did that. So I will move the approval of the consent items. Any discussion before we vote? Seeing none,
Ready to vote? Tom, Battaglia. Oh, no, Battaglia.
He keeps pushing.
Oh, okay, there we go. All votes are in.
and that motion passes 13-0.
That's how you lose at Jeopardy.
That's okay. Going to item number 2. Basically, the rule number 7.3 was revised by the committee, and the motion passed unanimously. The revision was to provide a 2-year time limit from the date of service retirement for a member to apply for a disability retirement. That was, I think, what was intended, but just not put in the first place. Johnny explained that and apologized profusely, and we accepted that and voted for it. So I will move to have that motion approved. Any discussion or questions? Seeing none.
Ready to vote?
And
George Kenny?
George, I think we're waiting for you.
I voted.
Oh,
Votes are in.
okay. All right, and that motion passes 13-0. Okay, we reviewed the biannual report on travel and training costs. Under old business, Cynthia kindly, well, 2 things. Cynthia, first of all, gave an amazing demonstration of gymnastics yesterday with the most beautiful curtsy I've seen in years. I'm not even sure that that's allowed anymore under the rules, but since she is identifying today as female, I guess it's okay. So that's good. So under, she did report under the board election
Now
update.
you know why he's not the board president.
Yeah, thank you. All right, so on the board election, just as a reminder, Charlie Hogquist will continue in his second term as the retired member representative, and Sergeant Louis Maggi will begin his term as the police safety member starting April 1st, replacing Thomas Sullivan. Under staff reports, Cynthia reported that the communication manager, Jessica Packard, the turncoat, has accepted a position in private industry, and the recruitment process for her replacement is underway. Marcel reported that the experience study will be based on the 6/30/19 valuation presented to the board in 2020. SDCERS successfully completed a disaster recovery experience, completing the February retiree payroll using our disaster recovery site outside of San Diego. I want to just take a second to just comment on that. It's not just that we have a disaster recovery plan and that we check on that and whatnot, but we actually ran the benefits in February off the backup plan. That's impressive. Most companies don't go to that length, and not only does it guarantee to our members that we have a disaster recovery plan that works, but it's proven, it's tested. So kudos to you guys, it's fantastic. So I just want to point that out. Information technology, David was telling us that I think the legal term of art is the crappy system we're using now is going to be upgraded, but unfortunately it's not going to happen until May. And there'll be some board member training for those of us who don't know how to use the new system. Ted gave a fantastic report, which I invited him to do. Ted today, you will notice, is wearing black and blue. He said that he's wearing that in protest of how he feels after he usually comes forward and gives his reports. So I just want to point that out, that he's at least, we've trained him to be consistent with his presentations. So, all right, that is the end of the B&G report. Thank you. And I'd like to also point out that despite Charlie being impinging on our time last week, yesterday, we were able to make it up and still finish early. So thank you.
What a surprise.
Thank you, Tanasi. That brings us back to the investment committee and the staff reports. Carol?
Okay, before the staff reports, I just want to summarize what the item A4. We had a presentation yesterday by Grantham, Mayo, and Van Otterloo, known as GMO. They're one of our global equity advisors, and they've had a sustained period of underperformance, which has been a concern to the committee. So we asked them to come in and help us understand what they do and why their results are what they are. I think we were all impressed by the integrity of their investment process and their investment thesis. So in a sense, they've had bad results for the right reasons. They have a well thought out investment program, but the market cycle is not in their favor, and there's a reasonable expectation that will change in the near future. And so I think we're all pleased with that presentation.
Is it time to double down?
I don't know about that. We've also added more global equity managers, and one of the points that came out of the discussion is that the managers are complementary. So while this one's been underperforming, another one's been overperforming, and it's a nicely mixed portfolio. Okay, we're going to have very brief staff reports. Jamie's going to comment on the private assets, and Anders is going to give us a brief summary of total fund performance.
Great, thank you. Beginning with the GCM Grosvenor portfolio, this is the performance report for GCM Grosvenor Pacific Fund for the quarter ending September 30th, 2018. The fund generated a combined net IRR of 15.5% since inception. Looking at the components of that combined IRR, private equity generated a net IRR of 16.6%, which outperformed both of the primary peer benchmark of 11.3% and the secondary public markets equivalent benchmark of 14.9%. Infrastructure generated a net IRR of 10.8%, outperforming its benchmark of 7%. And with that, I can answer any questions that you have about the GCM Pacific Fund. Great. Thank you. Moving on to Stepstone. This is the Stepstone Atlantic performance report for the quarter ending September 30th, 2018. This fund has generated a combined since inception net IRR of 14.2%. Looking at the components of that combined net IRR, private equity generated a net IRR of 16%, which outperformed both the primary benchmark of 11.3 and the secondary benchmark of 14.5. Infrastructure generated a net IRR of 6.9%, outperforming its benchmark of 6.8%. And with that, I'd be happy to answer any questions that you have about the Stepstone Atlantic Fund. Great. Thank you. For real estate, this is the real estate performance report for the quarter ending September 30th, 2018. For the quarter, SDCERS had a return of 1% versus the benchmark of 2%. The performance for the quarter was impacted by the DWS separate account, where transactions and closing costs were booked for a property that was sold in the previous quarter. For the 1-year period, SDCERS had a return of 10.3%, which outperformed the benchmark of 8.2%. That 10.3% is still a high return, and we should expect that returns will continue to moderate. Over the longer time frames, for the 3, 5, 10, and since inception time periods, SDCERS continues to outperform the benchmark. And with that, I'd be happy to answer any questions that you have. Great. Thank you. And then finally, I wanted to cover the DWS separate account. Let me get the update on the DWS real estate separate account. As you'll recall, this liquidation began in 2016. At that time, SDCERS owned 19 properties. Since that time, we have disposed of 14 properties. 11 of those were sold in the open market, and 3 of those were swapped for shares of a core open-ended commingled fund. That leaves us with 5 properties. One of those properties, this property is currently in the market, and it's within the sale process. We expect that transaction to close at the end of this month. The remaining 4 properties, 3 of those are expected to come to market this year and begin the sale process, and we would expect that those would close sometime between the end of this year and the end of fiscal year 2020. The remaining asset is in the process of doing the things that it needs to do in order to come to market. Although DWS has done a fantastic job with this liquidation, staff and the consultant, Ann Townsend, are continuing to work with DWS to ensure that the properties are managed appropriately and that the sale processes occur in a timely manner. And with that, I'd be happy to answer any questions that you have. Great. Thank you.
We're good. Thank you. So just to remind everybody, the DWS, which is Deutsche Wealth Services, which used to be REEF, was originally a portfolio of a number of individual property holdings that were very concentrated, and several years ago, we determined it was too risky to have such a high concentration, so much money in such a few number of assets. So by liquidating these into a really historically strong sale market currently in the real estate industry, we're redeploying those funds into much more diversified core
Commingled funds,
core
open
funds.
end.
And just to summarize, the private assets continue to generate strong returns. This is where we are making bets on active management to try and add some enhanced returns to the more passively managed listed assets. Excuse me, and execution has been really good. Thank you.
Thank you.
Who's that guy with the beard?
Not sure. Added 10 years to apparently, from what his wife says.
You'll reconsider that one day.
Yes.
Finally, we have some gray hair in the investment group.
It wasn't gray 5 years ago, I'll tell you that. Good morning, everyone.
Good morning.
Can I have the slides? So, like Chiron, I have some good news and bad news. The first bad news is I don't have the same heuristic skills as Tanasi, but I'm working
Neither do
on
I.
it. Looking at the quarter results, that's the bad news. We were negative in the fourth quarter, 5.6% versus 5.3 negative for the benchmark. The good news, so finishing strong. We've already made that up. So as of January and February, we were up 5.4%. And as end of February fiscal year to date, so July 1st to February 28th, we're up 2.7%. And I also, I'm sorry.
Don't look at today.
Does that include today?
Don't look at today and yesterday.
No, only February 28th. That's why we picked that day. That was a good
I
day.
wasn't commenting on today being so horrible, but it's like day by day.
It is day by day.
So this is a new slide that I thought I would highlight because we always talk about performance and we never really cover risk-adjusted returns. So taking into consideration how much risk we're taking for the returns that we're getting. So Aon added this slide for the first time, so I thought it would be worth covering it. Sharp ratio basically is risk-adjusted return. So how well are you being compensated for the risk you're taking in the portfolio? So you can see we're actually pretty good there. We're in the top 4% of our peers for 3 years, top 8% for 5 years, and top 16% for 10 years. So those are pretty good numbers when you compare to peers. So I think that's all I had in terms of my remarks. If there are any questions, I'd be more than happy to answer them.
I think we're good. Thank you.
All right. Thank you.
Okay, I think I'm done.
All right, thank you, Carol. That brings us then to training. And we have one action item.
Thank you, Val. George Kenny would like to attend the IFEBP Investments Institute, April 8th in Phoenix, Arizona. Other than that, I don't have any other training requests, but we'll need a vote on this.
All right, let's bring up a motion button.
Ready to vote?
All right, the motion's been moved and seconded.
All votes are in.
I'm going to abstain just so I can talk again.
George has abstained. Would you mind explaining?
I thought it was self-interest.
All right.
Or I'm in an abstention mode today.
That means it really isn't protesting.
All right, then.
Why did he attend?
Then that brings us to questions, comments from president, trustees, and staff.
Actually,
Sure,
No, go ahead.
Tanasi.
I just want to say, and I know we've covered it, but I'd like to thank the three of you guys. Personally, Tom, you and Val have been sort of mentors to me. I've appreciated you guys kind of taking me under your wing and helping me along. I also think that without saying anything about anybody else here, I think that the board and the program is weakened by your departures. I think you guys have been a cornerstone here, and I think it's I think what's most important is your example of it's your integrity, your commitment, your compassion, but more importantly, your empathy for all of the issues that come before us and for the members. And the other thing I want to point out to the rest of the board is that while Thomas's position is going to be filled by a new person who's elected, and right now there's only one candidate to fill the shoes of both Val and Bill. That's a concern. And I mean, you look no farther than me to know that it's very difficult to find qualified people who are willing to sit on this board because they accepted my application. But my issue is that it's going to those shoes are not only going to be difficult to fill, but it's a tough deal. And there's, like I said before, there's no real reward. And I thank you guys for doing it. I thank you guys for showing me the way, and I appreciate your work.
Thank you, Tanasi. Tom, do you have? Will you just say something?
You're the one that ostracized me to the zip code over here. No, it's been a very good 8 years. It was interesting how I ended up being on here. My brother had been on here for 6 years, and his departure, no one would replace him, which was a problem. So without any experience, without any education on it, I got thrust into this position, and the learning curve was straight up. But with the staff and the orientations and the educational opportunities, I think I did an okay job. But it's a commitment, and serving the police department has been an honor. So, and being on here, working with all of you, especially the staff, thank you very much.
And I'd like to follow on that too. Coming on this board with a financial background, I thought this was going to be pretty easy thing. Well, it wasn't. And I really appreciate the educational program that we have here, because going to the Wharton School and learning the institutional investment management was different from what I'd done as an RIA at one point in my life, and that sort of thing. Also, I've been very impressed with the staff, their professionalism and their guidance in getting us to where we need to go. I think in particular, working with the investment staff and Liza and her team, as was pointed out, we did pretty well against the benchmarks all the way along. One thing I would leave everybody with is don't be complacent. That funding ratio is still at 70%, and in December it dipped, so it doesn't take much.
Thanks, Bill. So my closing comments are that we are rewarded for this, and we're richly rewarded. And it's by being able to work with each other, all of you, and with our outstanding staff. Really, really capable people, and really nice people, and people who are well-intentioned, and serving the public good. And there's no greater reward than that. And we get the opportunity to learn. I mean, when the interest rate environment changes, we get to talk to the CEO of PIMCO about, what is he going to do about it? Who gets to do that? Well, billionaires do, and when we sit on this board and act on behalf of the board, I guess we're billionaires. So it's pretty cool. I would encourage anybody to do this, who really shares a passion for finance, but also for serving the members, because we can never forget that our central purpose here is serving the members. It's not serving a union. It's not serving taxpayers. It's not serving a constituency. It's not serving social justice. We're here to serve the members. That's it. And so, my warning for the board, I guess, is not only that winter is coming, which Bill will tell you, but that we need to keep the focus and keep the culture and the focus on the members and on doing our job, and not either saving the world or making decisions that seem good at the time, but they're foolish decisions in the long run. And we've got a great culture for that here, and we need to keep that going. The the last thing I'll say is timing is everything, and our timing's been really good for the three of us, and I think it's going to be good for all 13 of us. But timing is everything, and the only constant is change. So, keep your eyes on the ball, and thank you all very much for serving on this board with me, and I've really, really appreciated all of you. And you will be in very, very, very capable hands when we meet again next time, because our Vice President, Carol Broad, is going to be an outstanding leader. And everybody's going to bring a different leadership style. It's going to be a different style, but it's going to be every bit as good and maybe better. So that's all I have to say. Thank you all.
Thank you.
May I just,
Yes, please.
just a couple items. One is I wanted to bring up the board retreat we had on February 20th and really thank the board for their attendance. We had all 13 board members there, so I was very, very excited about that, and also for the active participation at the board retreat. And just really briefly, we had a very great session on the history lessons learned, the governance lessons learned through the great pension scandal that we had. And I wanted to recognize our general counsel, Johnny Tran, for putting together that historical review and highlighting all the different lessons and the things that we need to make sure we stay vigilant on going into the future to make sure we have continued success. We also had Dr. Mallon presenting an outlook on the future of investment markets through various regime changes. And similarly, his message was be vigilant. Avoid investment omission, avoid the things that you should be doing but you don't, and also avoid the commission, avoid the things you shouldn't be doing but you think you want to do. So that was very provocative regime change overview by Dr. Malin. We also began our discussion on SDCERS values. We'll be bringing that back to the B&G committee for further discussion this coming May. And we're going to talk about it.
Okay, I'm sorry. Okay.
And also we had board's training, which included the proper use of a microphone. And I just want to just to review, make sure you can go green and lean in. So it's as simple as that. And also I wanted to say again, thank you to Cynthia Joyner for all of her work in making that whole meeting possible by doing all the logistics. Thank you. Another couple items, we had a meeting with the City Council's new president, Georgette Gomez. This is part of a regularly scheduled outreach initiated by SDCERS to meet with the council president. We met with her and her chief of staff. At the meeting was our vice president, Carol Broad, Marcella, myself, and really doing a SDCERS overview of what's the hot topics and what's going on at SDCERS and why. And it was a very nice, positive 30-minute meeting. So we look forward to meeting with Ms. Gomez again. And also, I wanted to thank the board for the opportunity to attend the CalPERS General Assembly this week. There was lots of great information, but there's a couple I wanted to highlight. One was there was a great project management session on Lean Six Sigma, and that is a way to move your organization through effectiveness and efficiency. A lot of those tools we use here, but it was really great to go through that session because that more formal approach, I think, would fit really well for a project that Marcel and I are thinking about. So I'm pretty excited about that. We also had someone from the Scottish Railway Association come in to talk to us about Scottish communication strategies and how to better connect with your members. It's not just always about the message, but how do you connect with the members so people are listening and actually choose to interact with you.
And if it's not Scottish, it's crap.
And I can tell you, so that was one thing I learned is that we're going to have to actually do all of our videos with a Scottish accent. I think that would be very, very awesome. Another item which I found fascinating because I don't know a lot about it, which is why we go to conferences to learn more, was about blockchain technology and how would that be applicable into our business environment. So it was really blockchain data warehousing Netherlands style. So there was a gentleman from the Netherlands that came in to talk about it. And in the Netherlands, they have just a wide number, just a huge number of 401k plans, which are all highly portable. And they currently don't communicate with each other at all. It can literally take up to a year to transfer assets from one organization to another. But using blockchain technology, if you have that homogeneous group, you can actually do pretty neat things. I still don't know how we would use it here in the California pension systems, but it was great to get a great touch point on that. And finally, but certainly not least, there was an outstanding panel session about implementing benefit administration software. And on that panel was our own very own Marcel Voorhees-Rossman. And she did a great job. There was a lot of people coming up afterwards complimenting us not only on what we did here as an organization to implement our information system, but also Marcel's ability to communicate that effectively and efficiently. So thank you very much, Marcel. And to also mention, Tanasi went through this rather quickly, but we are going to have a new information system for pushing out the board agendas and also a voting system. So it's going to be very close to what we have now, but I believe it's going to be a new and improved system, and it's very important because we need to do this upgrade so that we can upgrade other platforms here in our information systems. We're hoping for a May implementation, but again, we're still putting the software through its paces. And so we want to go through and continue our rigorous testing. If we get the green light to go in late April, we are then going to have kind of an open house. We're going to publish some dates, May 2nd, 3rd, and 8th for you to come in, which is convenient with your calendar. It's about a 30-minute training session. If that doesn't work with you, we will work with you to find a date and time that is good with your calendar. And then we're going to try to reserve some time before the Disability and the Investment Committee meetings, even if we have to wait until then. And also an improved agenda format, going to move some things around and reformat it to help streamline the meeting flow. And lastly, I wanted to say a personal thank you to Tom, Bill, and Val for your service. I feel like I've only been blessed with working with you for a short period of time this past year, but all three of you shown yourselves as leaders with integrity and focused on doing what's right for the trust, which is what we need. And so I just wanted to thank you very, very much, and thank you for your service.
Thank you, Greg. That brings us to non-docket items, and we have none. We're going to have a short closed session. So at this point,
There are no items in closed session.
Oh, there are no closed session items. So we are free to adjourn the meeting. And anybody have anything else to say? No? Meeting adjourned.